fun and challenging. So in this exciting world that we're living in right now, this was one of our challenges, is that I'm showing up as Sonia Foster. Appreciate everybody's time. I'm going to be talking about the employee retention credit, and from an agenda perspective, a few items that we'll cover today. First, we'll go into some background of the employee retention credit, its initial introduction to taxpayers who had some sort of suffering from the COVID-19 pandemic, either in a full or partial shutdown by a governmental order, or in just a decline in their sales or gross receipts. We'll also cover some recent stimulus changes that were passed as a part of the Consolidated Appropriations Act in December of 2020 that expanded the opportunity for the employee retention credit and also extended the credit from an expiration of December 31st to June 30th. So we'll talk about some of the changes that were made retroactively and some of the prospective changes that were made to the employee retention credit. And then we'll, at the very end of this, talk about some of BDO's capabilities, how we're assisting companies in identification of opportunity, computation, ultimately through amendment of quarterly 941s to claim the benefit. So first, let's go back to the beginning of this. The CARES Act was originally enacted in March 27th of 2020 as a response to the COVID-19 pandemic. It created this employee retention credit, which is a refundable credit against employment taxes via your 941s that are paid. The credit applied to certain wages that were paid for employees between the periods of March 13th, 2020 and December 31st of 2020. The credit essentially equals 50% of all qualified wages that were paid to employees up to a maximum amount of $10,000 per employee or a $5,000 credit per employee. Employers, in order for them to be eligible, had to meet certain tests. The first test that we could look to was if there was some sort of a governmental order that restricted operations in either a full or partial capacity. So this could mean a local, a state, or a federal governmental order that shuts down your operations, essentially meaning your employees have to stay home, they can't come in. In certain situations, I think we were pretty lucky that we were able to transition and adjust to a work from home environment. Many companies didn't have that ability. And so they were essentially forced shut down, and employees went home and weren't performing any services. The other test for eligibility is related to a decline in your gross receipts or sales of greater than 50% when you're comparing a 2020 calendar quarter to the same calendar quarter in the 2019 year. So if you suffered in income, you could also be an eligible employer in that way. Now, the next item, so first we have to determine eligibility. The second is determining the qualified wages that are eligible for the employee retention credit service. For companies that averaged less than 100 employees in the 2019 year, essentially all wages that you had paid to those employees are eligible wages for employee retention credit. If you had greater than 100 full-time employees, the qualified wages were for those that were paid to employees to not perform services. So essentially, you're not coming into work, you're not punching in and out, but you're still receiving a paycheck. Those would likely be the eligible wage amount. Some of the complexity related to the headcount rule was related to control group issues in 52A, 52B, 414M, and 414O related to headcount. So this is a control group or an affiliated group rules. Essentially, all members of a control group or affiliated group would be counted as a single taxpayer. And that was one of the challenges that we saw early on with this, is determining which members of a controlled or affiliated group should be counted towards this headcount. And that would determine the amount of eligible wage that's available for the employee retention credit. There were some additional provisions provided in the CARES Act related to coverage of health care plan expenses. They were deemed to be eligible for the employee retention credit, and they would also count towards that $10,000 wage cap. So in some situations, we had companies that didn't lay off employees, but furloughed and continued to cover healthcare plan expenses. That coverage was eligible for the employee retention credit too. At the time of the CARES Act, when it was first enacted, the employee retention credit was not available to employers that also received a PPP loan. So these were mutually exclusive items. You could either look at the employee retention credit or receive a PPP loan. There were other restrictions that applied related to Families First and the work opportunity tax credit, essentially stating that you could not double dip on these additional incentives. So it was one or the other, the employee retention or these other opportunities. So some modifications were made, and we'll talk about the retroactive modifications that were made here. The first being that we just covered is that if you had received a PPP loan, you were not eligible for the employee retention credit. As part of the Consolidated Appropriations Act, they removed that provision, allowing employers that also receive PPP loans to additionally claim the employee retention credit. The impact here is that if you did receive a PPP loan and applied that towards a certain portion of the wages paid for forgivable loans from PPP were not eligible for employee retention credit. So essentially, you cannot double dip on PPP and ERC for the exact same dollars, but we still have room as PPP loans could apply 60% of that loan towards payroll and the other 40% towards additional expenses. If we're able to get certain wage payments above and beyond that 60% forgiveness, we can still apply those for the employee retention credit. Treatment of healthcare plan expenses. Part of the old rule was that although they were eligible for the employee retention credit, they were considered to be a separate wage or separate from the wage amount. As part of the new rule, the definition of qualified wages has been expanded to include those allocable healthcare plan expenses. Essentially, this doesn't change the rule. We can still claim the employee healthcare coverage as eligible. It's just now considered to be a part of the definition of what is a wage for employee retention credit purposes. So now we're going to talk about some forward-looking changes that were made in the Consolidated Appropriations Act. The first being that the employee retention credit was a credit that was established and given to taxpayers from March 13th of 2020 to December 31st of 2020. The credit has now been expanded and extended to qualified wages paid through June 30th of 2021. So we got another 2 quarters of eligibility via the Consolidated Appropriations Act. The employer eligibility under the gross receipts test was also modified from its original version, where in 2019, you had to show a decline of greater than 50% during a calendar quarter, comparing 2020 to 2019. The new rule for 2021 employee retention credit declined the gross receipts test to a decline of greater than 20% in a calendar quarter. Now, most of these calendar quarters in 2021 are still ongoing, and so the service has provided a safe harbor, essentially allowing companies to compare their fourth quarter of 2020 gross receipts to the fourth quarter of 2019 gross receipts. And if you had a decline of 20% or greater in that period, you have eligibility on a go-forward basis. So you can claim the expenses paid for wages to employees in the first quarter based on a fourth quarter decline of gross receipts. Another rule that changed here related to 2021 eligibility is the headcount threshold. are the full-time employee threshold. Again, as we note, under the old rule, it was companies with 100 or less employees on a full-time basis were eligible to claim 100% of the wages paid to their employees as eligible. They've replaced that number 100 with the number 500. So this allows a greater impact for smaller businesses that may have missed out on maximizing the credit in 2020 due to full-time employee headcount. So now with companies under 500 full-time equivalent employees in 2019, they would be eligible to claim 100% of the wages paid to those employees as eligible, assuming they meet eligibility requirements under the CARES Act. Additional changes that were made on a prospective basis. The old rule was stating that 50% of your qualified wages and allocable healthcare plan expenses were eligible. The new rule changes that 50% to a 70% of the qualified wage being eligible. So in the past, it was a maximum of $5,000 per year of eligible credit. It is now $7,000. Another change that was made to this was that in the original CARES Act, the credit was applicable for wages paid between March 13th to December 30th, and the $10,000 cap was in that entire period. The new rule creates a quarterly maximum, and the quarterly maximum equals that $10,000 threshold. So the prior version of the credit applying to 2020 wages was a maximum of $5,000 per employee from March 13th to December 31st. We're now looking at a maximum of $14,000 in the first 2 quarters of 2021. So that quarterly or that $10,000 threshold applies on a quarterly level, not on an annual basis. An additional change that was made in the Consolidated Appropriations Act was that wages paid to employees may not exceed, the old rule, the wages may not exceed wages that were paid in a prior quarter or prior equivalent quarter for that employee. Now there is no limitation. So if employees received additional pay or if they had bonuses paid out or a raise that went into effect, that would not limit the inclusion of that wage amount into the employee retention credit. One final change that was made in the old rule, there was no provision for monetizing credits prior to the wages being paid. So essentially you had to wait until your quarter closed and you could apply for it on your quarterly 941. Or if your quarter had already closed, you were required to file an amended 941 return in order to claim the employee retention credit. The new rule, and we are still receiving some guidance related to this new rule, but the Treasury will be drafting guidance to allow advanced payment of the employee retention credit for companies with fewer than 500 employees. There will likely be some limitations in play, but again, we're still waiting on some of that guidance to come out. Now, how have we helped companies in the past from a BDO perspective? One, the biggest challenge that we've run into with a lot of companies is determining eligibility either by the gross receipts test or the governmental order test. With some of the complexity that was placed into the law related to affiliated groups or control groups, it became challenging for many companies to determine whether or not they'd even be able to meet that eligibility requirement. Certain franchisees, such as restaurant franchisees, it was difficult to tell which members should be a part of that group. And that really limited a lot of opportunity for companies that may have had 1 or 2 restaurants or locations that were shut down and the others were continuing as operational to determine whether or not they would meet that test to be a qualified. So we've helped a number of companies determine eligibility on gross receipts or the governmental order test by evaluating that control group or affiliated group issues. We're also helping with identifying the qualified wages via their payroll records, creating surveys and executing with our clients in determining who is receiving compensation for not performing services, or if it's a salaried individual, are they not performing at the same level due to being working from a home environment? We've created a number of tools to assist with this, from an online survey to Excel models to determine eligibility and determine the amount of wage that would be available. This next bullet on leveraging Credit Connect, it's a software tool that we've created that we've helped assist with ERC credit implementation. This documents the reduction of productivity in an hours basis. It is also used as a repository to compute the credit. And so we're actually receiving compensation information and putting it into this software tool and assisting with a computation of the employee retention credit. We're helping a number of companies calculate the company on a quarterly basis. Currently, with the change in the Consolidated Appropriations Act, there's a lot of opportunity on a go back basis. So companies that had received PPP may not have fully been made whole related to that. There's a lot of opportunity to go back and look at the employee retention again to determine eligibility and determine the appropriate wage. We've also been assisting with preparing the Form 7200, quarterly 941s originally, along with amended 941 returns to claim refunds. One of the key areas that we're helping the most is in documenting these processes and procedures, including the eligibility tests. The landscape for taking advantage of the employee retention credit is likely very high. So having adequate documentation and support available, should these ever be challenged by the Internal Revenue Service, is something that is a key issue for a lot of taxpayers. So we're working with companies in reviewing governmental orders, ensuring that we're appropriately including all members in the gross receipts test and documenting that, just so they have that adequate support should this ever be challenged. We're also interfacing with our clients' payroll providers and the IRS to assist in resolving some of these issues. We've had a number of clients who have applied for the employee retention credit via an amended 941 that have not received a lot of input from the IRS. So we've had a number of calls with the IRS on whether or not they've received those 941s, what the timing is for processing that information, and when our companies and clients can expect to receive refunds. Typically, we're seeing somewhere in the 6 to 8 month range from a turnaround perspective on processing amended 941s. So it's not uncommon for companies who are really looking for some cash incentive here to have to wait for the IRS to process a lot of these returns. But we're definitely helping however we can in connecting and seeing if there's any guidance or information that we can provide. I will look for any questions that are coming up in the end, but for now, I'm going to transfer over to Michael, who's going to talk about the PPP loan in the second round of PPP.
Thanks, Randy. Before I start with the bulk of my presentation, I want to point everyone to an article that is I believe there's going to be a link to this in any kind of follow-up that goes out with this presentation. But in January, our national office put together a really good summary, because what I noticed as mostly a tax professional dealing with a lot of clients that are coming through, the decision making on these, that it's really difficult sometimes to keep track of the qualitative and quantitative elements of this, and also the lending and tax related provisions that are part of this. The one thing to remember with all of Randy's presentation, he's dealing with the employee retention credit, and that is a tax IRS code based, those are IRS based provisions that they're not subject to the whims of lending and the SBA and their administrative rules. The PPP part of this is in the SBA's realm, and you'll notice that sometimes you read, or the CARES Act or all these subsequent amendments will come out, and it will read a certain way, and there'll be certain language, and the SBA will interpret that language differently than the Treasury does when tax provisions are written. So I do think that what I'm seeing mostly is that when they opened up retroactive use of the employee retention credit, I'm noticing that a lot of people are now qualifying because there's some similarities in the testing that goes on here. So usually if you qualify for one, you're probably going to qualify for the other. And I'm noticing that it's really just keeping these straight is a big thing. And this article is excellent at that, because as you go down, there's a matrix here which actually goes through some of these rules and in terms of determining eligibility. It's really good. This is a good resource, especially if you're familiar with the first loan, the first PPP program, to get straight with the next one, because we're not going to be able to hit every single topic for every single client. I'm going to now share my presentation. So the first things first I wanted to go through are the material changes, and everything with the PPP loans. As anyone who's been through this at all knows, this is what it is today, right? We started with the CARES Act, which released a bunch of these provisions, and then it has been amended, and special rules have come out, Q&As have come out. It's really evolved, and it seems to take on a new life every 6 to 8 weeks. For those of you who are in this, and sometimes it's really difficult to keep track of everything that changes. What I do want to highlight first before I go into PPP2 are the material changes that happened with retroactively that you guys need to be familiar with, because I think they're real material, not only in your tax filings for 2020, but also to understand the benefits of it. The first things first, the most significant one was the forgiveness of the Treasury was taking a position that expenses were not deductible that were financed by PPP loans, but that's gone out the window. Those expenses are now deductible, and the proceeds of forgiveness loans are not taxable income. So if you're running an S corp, it goes through your OAA account. If you're a partnership, it's just you treat it just like you would in M1 or M3 for tax exempt income. It's not it increases the basis of those assets, but it's not taxable income. They did, versus the beginning when everything came out, they have subsequently come out with some relaxed provisions as it relates to loans under $150,000 and under $50,000. If you're in a really hard hit industry, and you don't get bogged down in a lot of the FTE requirements, the full-time employee requirements, the reductions, you can actually get some relief on these EZ forms if you have the qualitative, if you've been shut down, or you've been subject to a lot of the same shutdown rules that have affected the most highly hit industries. So almost all of them can qualify in this EZ form. So if you're in the highest hit industries, definitely look at that form before you start going through the regular application process for forgiveness. For loans under 50,000, you don't even have to worry about full-time equivalent requirements. And so there's a little bit of an interplay there. So if you received a loan between 50,000 and 150, and you've had some layoffs, some furloughs, always pay attention to this $50,000 number. Never submit a forgiveness application lower than $50,000. That's kind of the floor on that. The other part of it that wasn't mentioned before, but EIDL grants, if anyone had received those are no longer counted towards the forgiveness application. And one of the interplays that also goes with the employee retention credits that I think is going to be real confusing, and a lot of people are going to be involved with trying to calculate this, and this is where we've been pretty useful. You can't double dip. So you can't use wages that you use for a retroactive credit for employee retention credit. You can't double dip and use those for PPP forgiveness. So we're expecting more guidance to come out on, hey, I have filled out my forgiveness application already and I put all my wages in for 24 weeks. I didn't foresee this coming out in December, and I don't know whether I can use the wages that I put on that report and then go back and qualify for ERC. We believe that some guidance will come out that will allow you to do an independent calculation and make that determination. So my recommendation is if you have had enough of expenses, forgivable expenses and payroll combined, using that 60-40 matrix, if you've had enough of those qualified expenses to get forgiven entirely on your loan, and you also have an excess amount that you could also use to get employee retention credits, my recommendation is you just document that and be in position to take both. There were also some new expansion on it. I'm not going to go into this in too much detail, but they include now group life, disability, vision, or dental insurance. So those were, and there's also some other expanded coverage amounts like business software and cloud computing, property damage costs, supplier costs, et cetera. So there's some expansion on the amounts that can be forgiven that weren't explicitly put in the CARES Act. One other, I think, material change is, and this affected people who are mostly partnerships. At the beginning, there was a lot of uncertainty as to whether or not partners with self-employment income were going to be eligible to include their $20,833 or their, let's just say they were $100,000 salary. They weren't. There was a lot of uncertainty at the beginning whether you could include those amounts in applications because they weren't employees. They subsequently went back after most people had applied and said they were. So there's a lot of opportunity there for people who didn't include partners with self-employment income, and they can actually go back and get that additional 2833 or whatever that number is that they have in self-employment income. So definitely pay attention to that for clients if they had a limited PPP1 application. Make sure you go back and you can maximize the amount that they get. I think a lot of the questions probably you guys have is eligibility on the second round. There were some changes that they made versus the first. And I'm gonna try to go through this in bullet points, but the one thing there were people who were either uncertain whether they wanted to take the PPP or didn't know whether it was going to affect them. And if you're eligible for the first PPP loan, this second draw opened up the window for you to go ahead and make a first application. And if that's in the cards for any of you, in terms of if you did qualify for the first one and you decided not to, and you want to go ahead and go forward with the first one, you can do a first and second PPP application at the same time. So don't think that you can't get the second round. If you don't think that you have to have this horse race where, oh man, I got to get my first PPP loan now, and then I have to exhaust it within 8 weeks, and then I got to apply again. You can actually apply for the same loan twice. The CARES Act had a 500 employee, and remember when you're doing the employee retention credits, they talk about full-time employees. For the CARES Act and for the PPP loans, it's total employees. So there are some nuances when you're going through this to make sure you get employee count. When you're talking about employee counts, there's usually full-time employee equivalents, which is what you use for forgiveness applications. There's full-time employees, which you use for employee retention credits. And then there's just total employees, which is what you use for PPP. So that just adds to the complexity and confusion of trying to manage both of these programs. These are some more provisions that opened up for housing cooperatives, certain news organizations, certain other entities that were excluded the first time around. And it does make certain entities ineligible. And there's another Save the Stages Act that came out. So if you have any entertainment promoters or venues that were shut down, obviously, during this pandemic, there's a special program for them that's actually more generous than the PPP program. So you should look at that if you have any clients that are in entertainment, performing arts, et cetera. Make sure that they look at that program before they apply for PPP, because once you get approved for the PPP, you disqualify yourself for that program. The original loan, as you know, is 2.5 months. That's also the same for the next one, except for specific industries. That's hotels, restaurants, etc. They have a 3.5 months times their average payroll costs. So if you have a restaurant, anything in the NAIC 72 code, which is restaurants, hotels, etc., make sure and most of the lenders will keep them straight if they have a 72 NAICS codes, because they're looking at their tax returns and they'll know that it's a 3.5 months expanded number. Remember too, if you're going in for the second one, you can take the easy route and just take the amount that was given in 19, or you can look to see if you have additional payroll costs that now came into play that weren't in the first PPP calculation. So the biggest ones of these are obviously the insurance amounts. You can also use 2020 payroll. So you have an option of using 19 payroll or 20 payroll and then adding these figures. There's also some additional, and I think we went through that basically before in terms of the forgivable expenses. So who's eligible for PPP2? You had to have a first PPP loan, which, you know, if you're going through this the first time, you can, like I said, do two applications back to back for PPP1 and PPP2, and they'll give you PPP2 when your funds are exhausted from PPP1. So you had to have an original loan. It decreased the amount of employees from 500 to 300, and then it kept the same codes. There are some specific codes for the 72 series and a lot of the hardest hit industries, the chains of restaurants and hotels that allowed them to qualify even if they're over 300 in total. The big test here, I know Randy went through the 20% reduction for the fourth quarter to qualify for 21 ERC credits. You have to have a 25% reduction in gross receipts from any quarter of 2020 versus 2019. And so you can see there's some similar tests here. They're using gross receipts, they're using basic income categories to determine, you know, who's eligible. So there's a lot of quantitative synergy and qualitative synergy too. If you've been shut down, there's also a standard where you can qualify even, you know, under those qualitative procedures, even if you haven't had this revenue or receipt reduction. But most likely, if you've been shut down, you're probably going to qualify here. And as we all know, or some of us know as accountants, it's easier to pass the quantitative test if you pass it and have certainty, rather than rely on opinions as to whether or not you've been shut down enough to qualify on the other standard. So I always recommend that people test the quarterlies first, even if they've been shut down, just to have that certainty in your back pocket. There's also some entities that there's some new exclusions in here with political activity, China, people who get that Venues Act that I was talking about, people who are foreign agents, and then also I think there's, if you're related to people in Congress, you also have that issue. So I know that there's been some controversy around that, so they made them ineligible. Okay, going into the maximum amount, it's 2.5 times as we had already discussed briefly, except for the 3.5 times in this NAICS 72 entities. They did put a big overall limit on an affiliated group, and this came out after the CARES Act in a executive order from the SBA that just said, and what they did is it used to be, it was a bigger number for the first PPP round, but they lowered this in addition to lowering, you know, the total employees number from 500 to 300. They also limited the affiliated group, which it's a similar standard as Randy was talking about with the code section 52. It's the controlled group of entities. Those overall are limited to 2 million per loan. So each loan itself is maxed at 2 million, and then 4 million for the whole group. Because with ERC, you qualify as an affiliated group. So if you have to add in all the receipts from all of your different affiliated entities. For the PPP, it doesn't work exactly the same way. As you guys know, if you've been through the process, pretty much affected entities could have applied separately. So there's not necessarily the same determination, or, but the interesting part is of the ERC, though, once you qualify in your affiliated group, it applies to every entity in there. So it's like I said, I strongly encourage everyone to do the quarterly testing, and then look at the fourth quarter and look at all the quarters to see if you qualify for one or both of those programs. There's other special rules too that are really facts and circumstances driven. These are some things to be concerned about as you're going through the process. March 31st or exhaustion of funds are your deadlines. So I don't know whether there's going to be enough funding in the program to last till March 31st, but in any case, even if there isn't, that's the deadline for the second. It talks about the exhaustion of funds. So that's why if you're going for a PPP 1 and 2 at the same time, just make sure you do the applications together so that you'll have that in before March 31st. Oh yeah, payroll for he talked about the ERC, so we'll pass on that. There are a lot of these things, as you know, going through both of these. There's a little bit of an interlay here. Okay, the dates. If you're going to go back and look for retroactive employee retention credits for 2020, that due date for the 941 was January 31st, but you can always file an amended 941Xs, which is what we're doing now for a lot of our clients, and then pretty much the same rules with the FFCRA. So that is I think, enough of PPP 1 and PPP 2 information prior to our question and answer session, which I think usually in these examples, getting Randy and I to talk about our actual client experiences that are going to be more valuable to you than going through line by line all these items that are sometimes overwhelming and confusing the first 2 or 3 times you go through them. But I do want to redirect you back to that article if you have questions about eligibility, because it's very detailed. But also let's go ahead and start our Q&A.
Thank you so much for all of that information. It was really incredible. I know I learned a lot. We are going to open this up for questions. I know John had one that he wanted to bring up while everybody starts writing into the chat, and then Sonia and I will put voice to those questions for Michael and Randy.
So on the FTE or full-time equivalent calculation, do the employers establish what that is, or is it measured on the same standards as the ACA?
It's the same standards as the ACA so let's get this straight. There's a difference between PPP and ERC. So ERC, okay. ERC full-time equivalence is based on ACA. Full-time equivalence as it relates to getting loan forgiveness, that's a different thing entirely. You're supposed to do that calculation based on their standards of how much people contribute to the organization. So let's separate FTEs as it relates to loan forgiveness, which is a separate thing. So if you're going for loan forgiveness, for instance, and you have to meet the FTE standards, those are still in play from 19. So that's been the really tricky part of PPP2 is clients who had a lot of layoffs. They're stuck with a very big full-time equivalent number going into PPP2, and they don't think that they're going to be able to necessarily, they know they're going to be limited in forgiveness based on the percentage of employees they have now, or the equivalent full-time employees they have now versus what they had in 19. But I'm sorry to do that, but you have to make sure that they're using employee language for both, and they're applied differently. But for the ERC, full-time equivalent is the ACA standard. Full-time equivalent for the PPP is entirely different.
Can you give an example of a standard that could be used for the PPP loan to measure that?
They have examples, but usually it's a half. If it's a part-time employee, if it's closer to a half, it's a half. If it's closer to a full, it's a full. That's
Okay.
that's kind of the general rule on that.
All right, thank you.
We have a couple of employees.
There's nothing, before I say that, there's, people already disclosed an FTE number on their original PPP application, so you're kind of stuck with that.
Okay.
We have a couple employee retention credit questions regarding, one is the ERC available for special districts or tax-funded government entities?
That's a great question. No federal government or state or political subdivisions are not eligible for the employee retention credit. So it does look like there's some limitation there from a governmental entity.
So when the ERTC states that there's a governmental shutdown, that is when the employees cannot work in any capacity. Is that correct? What about a partial shutdown?
Partial shutdown would also absolutely qualify. I mean, I'm always going to point back to the restaurant example for that. There were a number of restaurants that were shut down in certain locations, or they had requirements to separate tables by 6 feet in distance. That is considered to be a partial shutdown, and so that would be eligible. Even though those employees can still come in, they may have reduced capacity or reduced headcount for servicing and not paying some of those employees to come in who would normally be on a shift. The governmental shutdown does not mean that you don't have to work, but it's just that you cannot go into your workplace. So if you are in a situation where there's a governmental order, a mandate that says you cannot work, the real test is, are you continuing to pay your employees for not performing any services, or continuing to cover healthcare plan expenses while not performing services? And that's the eligible wage portion that we can consider.
And just to piggyback on that, remember that there is you're talking about the qualitative standard of what someone was shut down, but there is a foolproof quantitative standard, and almost anyone that's experienced a substantial shutdown will have a quarterly, they'll have a 50% reduction in gross revenue, right, from those quarters. So I think you only have to really get into these arguments only when you've exhausted all the quantitative bright line tests that are out there.
Okay, thank you. We have a question in about completing the PPP application for forgiveness. Should you include those employees that exceed 100,000 on an annual basis and then exclude dollars in excess of 100,000, or just totally exclude the employees?
So you're bound by a overall payroll cost limitation. You don't have to include healthcare costs in that $100,000 limitation, but yes, if you have an employee that's making over 100,000, they're limited to that. If you use the 24-week covered period, it would be whatever that equivalent is, or I guess it doesn't have to be 24 weeks, but most people have used 24 weeks because there was no disadvantage to doing that. So you could apply it, like 46,154 was the number that you could apply to any any employee that's making over $100,000. So that's what you're capped at. What's interesting is if can you use those excess costs over 100 for the ERC? Yeah, I think so. So there's some interplay there with both of those rules, because those top end exclusions don't exist in the ERC, but they do exist in the PPP. But yes, you're bound. So any employee, you can only take whatever the equivalent is weekly. If you break down what $100,000 is over the year and then you multiply it by your covered period, you come up to what amounts to a weekly amount for a $100,000 employee, and then you multiply that times the weeks of your covered period, and that's the maximum you can include on a forgiveness application, excluding their healthcare costs. Like I said, that's something different. So yeah, and what you need to be concerned about too is even though employees are subject to that, if that person owns over 5% of that company, let's say an S corp, then you're limited. You have a hard cap limit of 20,833, and that hasn't changed. They haven't issued any guidance that's changed that, even with the 24-week extension. Every partner every S corp owner over 5% or greater, you're limited to 20,833 on a forgiveness application, even if they make over 100. But for anyone who's under that, who's a 100,000 employee, you can go up to the 46,000 for the 24-week period. Hopefully I've answered that.
Thank you. There are a couple more questions for ERC, and then we have a few more coming in for PPP too. So regarding ERC, for gross, what basis are they using for that calculation for reduction of receipts? Is it cash or is it accrual?
That's a great question, and this does create some complexity, especially if you have members of a group that are on different methods. So you may have some that are on cash and some that are on accrual. We're using the definition in section 448 to determine gross receipts. So it's essentially whatever is their method of computing gross receipts. That's the method we would use to compute that decline in gross receipts. So it's either cash or accrual based on their existing method of accounting. If you have members within the group that are cash and members that are within accrual, we would count those gross receipts on their own individual methods and then aggregate those together to determine whether or not they're meeting that test.
And I think it's 446, right?
That's 448.
448, okay.
Yep.
And then there's one more on the ERC, which is, Randy, what's your opinion on businesses that are experiencing supply issues because their vendors are shut down, qualifying as partially shut down for ERC?
Yeah, that's a great question too, and it is an area where we can look to eligibility. I'll share a story. I had a client that was a plasma donation center. And their business is essentially paying people to donate plasma and then selling that plasma. So they had a number of locations along the U.S.-Mexico border, and when they shut down the border, they couldn't receive any donations, so they ended up closing. We took the position that was a supply chain disruption. They received none of that plasma, and so they remained eligible or were granted eligibility because of that supply chain disruption. So that is a way to still qualify for the employee retention credit without having that significant decline in gross receipts or directly impacted by a governmental order.
Thank you. We have some question about the PPP loan and getting clarity around that 24-week used for the first loan. So I'm just going to repeat this question here. If you apply for both PPP 1 and PPP 2 at the same time and use the 24-week period to use the PPP 1, will you be able to draw the PPP 2 even though it will be after March 31st of this year?
Yes, you will. And it's so the determination of whether the funds are available or not when they're actually paid, it's when when your application's approved and you sign the loan docs, that's when you have an appropriation. So, you know, the funds will be available. You won't be able to draw them until you've exhausted your first one. But there is, I believe, a hard cap for 12/31. You know, and I'm saying that because the tendency of things in this legislation, if you followed it at all, is it's like I said before, it changes every 6 weeks. So, you know, that may get extended. You never know what that deadline is. But yeah, you could, you know, you should try to exhaust your resources. So it doesn't have to be the full 24 weeks. So if my recommendation on that would be, if you've reached full forgiveness, if you've taken advantage of all your ERCs that you can, and you've hit that forgiveness number in say week 12, just apply for forgiveness in week 12 and take it, right? So there's you have your own discretion as you're managing PPP 1 and PPP 2. But yes, you should, as long as the loans have been approved, it should be set up for appropriation and it will be dispersed to you after the 31st.
So I want to ask a question for those of us that are not accountants. Chris and I were talking about this when we were muted on our end, but I think it's maybe something people are thinking about. So when people are calculating a loss in revenue, my understanding of this, and please correct me, is the only thing that they can look at is receipts. So the revenue that comes in based on goods or services sold, not their profitability.
It's not on their profitability, but it's a much more expanded definition of total income. So my recommendation is you just be a little bit more cautious when you say just gross receipts. because it's total
Okay.
income. I think they break down, you know, there's some exclusions in there for certain types of unusual, or, you know, not in the normal course of business transactions, but you can assume that a lot of the income that derives even indirectly would be included. So it's more of a total income standard.
Okay.
Great. And then just, I know that you stated this earlier, but to give some clarity, if somebody doesn't qualify for the second round of PPP loans, and they never applied for their first round, they can apply for their first round of PPP loans now.
They can, yes. We encourage you to. And you can't take a PPP2 unless you took a PPP1, right? So one has to follow the other. But yes, as long as you were in business before, what is it, the 15th of February, and you know there are certain standards you had to meet in order to qualify for PPP1. But yeah, if you did, you by all means look at the test if you qualified for PPP1 and you just decided not to take it, or you didn't know about it or whatever. And as long as you qualify, yeah, get both applications in at the same time. You're almost certainly going to be using, I mean, I guess you could use even different standards. You could use 19 for the PPP1 or 20 for the PPP2 if you wanted.
There's one more PPP question, and this is, we used the 8-week period following receipt of the monies from PPP1 to begin the payroll forgiveness. On PPP2, do we need to use the same 8-week period following receiving PPP2 monies, or can we use a 24-week period?
You can
does it also have to start immediately following receipt?
You can, yeah, that starts on receipt. So your qualified period starts when you receive the money. That was the same with PPP1 and with PPP2. And you can use 24 weeks on the next one. Yeah, the 8-week method doesn't bind you. They've gotten really a lot less restrictive. So you can really ask for forgiveness anytime after 8 weeks and before 24 weeks. So yes, you could use the full 24-week period. But remember, if it's over 50 grand of a loan, you're still bound by the FTE requirements of your first loan.
And I think the other thing I want people to remember is that there is an end to this, and there's a limited amount of funds. So if you think you qualify, you need to get after it.
I just had one other question about the ERC. So the new guidelines, do they only apply for the first 2 quarters of 2021, or can you retroactively apply them? And I was just thinking of like the $10,000 cap per quarter instead of per year. Can you apply that back through your quarters through 2020, or is that only for the first quarters of 2021?
Yeah, the changes in the Consolidated Appropriations Act related to the cap amount only applies to Q1, Q2 of 2021. So retroactively, the change was essentially that if you receive PPP, you are now eligible for ERC, and it's also yeah. So that it's on a go forward basis.
Thank you. And we are just about at our time and didn't have any other questions come in, so.
Yeah, I want to express our thanks. You guys did a fantastic job in this presentation. It was really well organized. I learned a lot. Chris, comments?
No, I just want to thank you, Michael. Thank you, Randy. Your audience today has been, you know, a pretty good group of Western Colorado small businesses, and maybe other businesses in outside that region, but very much appreciated from our part of the world, and very much on point and on topic.
Great timing.
Things that we need to know about, and I encourage all of those. It's hard to cover this stuff in less than an hour, so get with your advisor. We're always available at Auto Paychecks at W. Lynn & Company, and can connect you to the right advisors and resources to make sure that you're handling PPP1, PPP2, ERC, whatever other acronym you want to throw out there. Yeah. We can help help get you connected.
Yeah, the other thing to remember is, as we mentioned several times in this, these rules are in flux. They tend to be. So be sure that you do stay in touch with that professional advisor of yours, because they're a moving target. One last reminder, on autopaychecks.com, if you select the blog, and then there's a sorting tool, little blue boxes, you can select webinars, and later today that will be up, as well as other presentations that Dalby Wendland and other partners have done. There's a great pool of information there. So, gentlemen, thank you so much. We appreciate all of you that attended, and we are on time and out the door. You guys have a great rest of your week.
Thanks, everyone.
Thanks so much, everybody. We appreciate it.
Thank you.
Thank you.